This is the current federal tax developments for the week of October the 13th, 2025. Current federal tax developments are brought to you by your state society of CPAs. Let's talk this week about some things that have gone on. First, I'm going to talk about the updated SIFL rates. If you have non-commercial airline flight compensation, we'll talk about that. We'll talk about a case where a taxpayer tried to use the Administrative Procedures Act to go after and attack the decision-making of the supervisor for a penalty. We'll discover how the court said wrong thing to raise. We'll talk about a tax exemption that was denied for a gated community homeowner association by the tax court. Also have a taxpayer that was arguing about whether or not he had income from the tax cancellation of indebtedness and which year he had it. But he ran afoul of what's called the Variance Doctrine. That is, it's a problem that if you don't raise issues in your administrative filing with the IRS, in this case, generally that'll be a 1040-X, if you later take him to court to try to sue for that refund, which is what was going on here, you have a problem. You can't really bring up a new topic. So we'll talk a bit about that. We'll also talk about the IRS's part 2 of the government shutdown plan. In this case, basically just under half of the IRS employees were furloughed after the 5 days. So we discovered that this week, and that plan apparently runs forward at least through the end of tax season. Presumably we won't be shut down that long because that would be some really big issues, but we'll take a look and see how that goes. We have the IRS released also the inflation adjustment numbers for 2026. So these aren't the ones for the returns we'll be preparing for 25, but the ones for 26 years. We'll talk about accounting method failures and reconstruction of income, a rather fact-based case, and also a concrete injury requirement, a taxpayer suing an ERTC advisor who they thought gave them bum advice. And we'll talk about why it didn't really matter if they did or didn't, because the taxpayer was unable to show damages. You can't really sue somebody if you can't show damages generally. So let's talk about the SIFL rates. This is Revenue Ruling 2025-20, came out on October the 3rd. Now, this guidance deals with non-commercial employer-provided flights. Your company owns an aircraft, and employees are on the plane, maybe tagging along to go places. So this gives updated, because every 6 months it gets updated, the terminal charge and the standard industry fare level mileage rates. So these are used for valuing that non-commercial flights on employer-provided aircraft, the employees coming along, how much of that is compensation. The rates are used to calculate the value of the flight, which of course is a taxable fringe benefits under Section 61. And the rates are calculated by Department of Transportation. They are reviewed and changed semi-annually. And so there are periodic updates from the IRS. We see this every 6 months. This is simply the most recent version. Now, these valuations are governed by a specific rule found in Treasury Reg 1.61-21G. And the value is determined using the base aircraft valuation formula, which is known as the SIFL formula. The formula components involve multiplying the applicable SIFL cents per mile rate by the appropriate aircraft multiple. The regs have a standard multiple in there to use. Then you add the terminal charge, right? And if you're doing any of these things, you're in payroll, and you have this issue in your company, you got to make sure you're using the correct aircraft multiple as provided by the regulations. And also, it's helpful to use the correct valuation numbers. And this is what this gives us. Now, this ruling will cover flights taken in the second half of 25. So these are effective for the period from July 1st of 25 through December 31st of 25. The terminal charge for that period will be $53.62. And the SIFL mileage rates up to 500 miles will be 29.33 cents per mile. 501 to 1,500 miles, it'll be 22.37 cents per mile. And over 1,500 miles, it'll be $21.50 per mile in the structure that we're going to be working with. Now, compliance, you want to make sure processes are in place for that semi-annual review and implementing the updated SIFL rates. You want to verify you're using the proper aircraft multiple under Reg 1.612 on G7. is applied for the accurate valuation from the regs, these are obviously only apply to non-commercial flights provided by employers. And there is a contact information if you get the download the materials, or if you're watching here on the video, you would see on the screen a contact information for an employee at the Office of the Associate Chief Counsel, Employee Benefits, Exempt Orgs, and Employment Taxes. I'm just not sure Kathleen is actually answering the phone right now. That's a different issue. Next up is a tax court case published, Computer Sciences Corporation versus Commissioner, 165 TC number 8, so review tax court case, and it came down on October the 6th. Now, in this case, the taxpayer got a little creative in trying to apply the Administrative Procedures Act. Administrative Procedures Act has been successful, used to successfully challenge a number of regulations recently, but like a lot of things, when something starts working in court, we sometimes see the idea stretch beyond where it reasonably seems to make sense. And I think this one comes fairly close to that. This case involved a substantial understatement penalty. It related to a complex $651.2 million capital loss realized from a basically structure called Project Trinity. The taxpayer, which was CSC, conceded the revenue agent's supervisor timely provided written approval of penalty termination. Remember, that's been a big deal for a while. The law requires, and we've gone through various rulings and courts of appeal, have not necessarily agreed with the IRS about what constitutes timely approval, but that's not the fight here, right? However, CSC argued the approval was invalid under the Administrative Procedures Act. And that's an act that generally outlines how the IRS or other organizations, other government agencies go about issuing final rules, basically regulations, right? But they said it should apply to this as well. It asserted that reasoned decision-making was required beyond a timely written signature. And the reasoned decision-making is effectively part of the APA for issuing a regulation. And CSC contended the supervisor failed to consider the reasonable basis defense that was predicated on a disclosure they made on the wrong form, 8886. But they said, hey, you guys knew this was there, even though we didn't actually do a reasonable basis on 8275 as well. Okay, now, IRC section 6751B1 requires the initial determination to assert a penalty must be personally approved in writing by the agent's immediate supervisor. Now, the tax court reiterated in its opinion its refusal to impose a subtext demonstrating the depth or comprehensiveness of the review of the supervisor. The question is, did the supervisor approve the penalty, not how much time the supervisor spent approving the penalty. So supervisor approval is timely if it's secured before the assessment of the penalty or before the supervisor loses discretion over the penalty, which is a view adopted by several appellate courts, not necessarily all, right? We have a little difference here. And this approval was, under this rule, timely secured before the IRS formally communicated its intention to assert the penalty via the 30-day letter. So bottom line, the time is not an issue, and CSC is not charging it. Now, they're going to reject the application of the Administrative Procedures Act entirely. In fact, the tax court said there are 4 separate reasons why it just doesn't apply here. Number 1, the court says, under the law, the deficiency proceeding rules of the code found in 6751B1, right, govern, and that tells that there'll be a review of compliance as necessary to determine penalties, making it part of a deficiency case governed by the code. It is not an APA governed item. This isn't issuing a reg, effectively. There is no final agency action, and that's the key thing. APA applies that. A supervisor's penalty approval is merely an intermediate step, right, and does not constitute the final agency action that would be reviewable, assuming this was the type of thing that was, under Title V, United States Code 704, the Administrative Procedures Act. Notice the deficiency that's issued later reflects the consummation of the agency's decision-making process regarding the penalty. So essentially, you can't go at this point. It also said, under the APA, generally you're allowed to challenge if there is if no adequate remedy exists. Even if this approval was a final agency action, The APA reviewed is allowed if there is an adequate remedy in court, and the law provides the tax court reviews compliance with the approval. As such, it's not an APA-governed item. And also said, they're going to say, if we, for argument purposes, we're going to go ahead and accept that somehow there is an APA-imposed requirement there be reasoned decision-making applied to this step, the supervisor did not abuse discretion by following Regulation 1.6662-41F, which requires the disclosure for reasonable basis defense being made on Form 8275 or 8275R. You can't put it somewhere else. And that's what they're saying. The administrative record showed the supervisor met with the CSC representatives, indicated he did consider the availability of the defense. You just fouled up and didn't follow the regulation and disclose this in the manner you're required to disclose it. Now, practical implications, in penalty defense, we're still mainly looking at written approval requirements, not how deep the supervisor looks at something. And the APA is not going to work to force that issue with the tax court. Challenges based on the APA requiring a detailed decision-making process for IRS penalty approval steps will likely fail in deficiency proceedings because that's what the tax court's going to impose. Very important, if you have a disclosure on the tax return and you want to be able to protect yourself from raise a reasonable cause defense, be sure you use 8275 or 8275R when it's required by the regulations. The fact that you did, you attached the form that said this is a reportable transaction. I can understand why a taxpayer might think that was good enough, the 8886, for this defense. But the reality was, no, it didn't, right? You needed to have the disclosure because they found that there was not substantial authority. They also found that therefore there wasn't, reasonable basis option because you hadn't done disclosure properly. And so the court ultimately found the IRS's motion for partially summary judgment on the penalty procedure issue, right? There's still other challenges you could raise. Next up is Mira Vista Homeowners Association, Inc. versus Commissioners. It's a tax court memorandum decision, 2025-102. Decision came down on October the 6th. Now, let's take an overview of the case here. Mira Loma Homeowners Association was essentially a Texas nonprofit, right? It operated a gated community. It wanted recognition as a tax-exempt organization under 501c4. Inside the gated area, the association maintained common areas, including 25 miles of private streets, green belts, and a recreational facility. Now, the association claimed its activities lessened the burden of government. The government didn't have to worry about code enforcement, private security, or road maintenance. But the IRS didn't buy this, issued a final adverse termination because the association did not benefit the entire community surrounding area on an unrestricted basis, but it restricted its benefits effectively and overwhelmingly to those inside the gated community. Now, they're trying to say they're a social welfare organization under C4. And on a qualifier under C4, you got to be a civic organization, you got to be not organized for profit, and got to be operated exclusively for the promotion of social welfare. Now, exclusively doesn't mean exclusive. We get all through that on the political activities of these things. That's not what we're talking about today. But exclusively does mean the organization must be primarily engaged in promoting the common good and general welfare of the people of the community as a whole. This is under Regulation 1.501c4-1a2i. The courts, including the Fifth Circuit to which this appeal would go, apply the standard that a single substantial non-exempt purpose precludes exempt status. And an organization that operates primarily for the benefits of its members does not serve a community within the broader social welfare context. In essence, effectively, remember, with a homeowner association, the owners of the HOA are those people living inside the gated community. They're doing this for their own benefit. That's kind of where the problem is going to come. Now, the court had some factual findings and did note there were some public benefits, but they were incidental, not really primary, right? The court did not agree with the association that the IRS was acted wrong in denying their exemption. The court found that any public benefits derived from their activities, security, road maintenance, were found to be merely incidental, not primary. The association's facilities, its lake, its recreational venues, were primarily for the benefits of its members, and most times were simply inaccessible to other members of the public, right? Restricting membership to property owners and maintaining member-only common areas behind a gated private road indicates the entity solely advances the private interests of those inside the gated community, the people that own the association. So essentially, it was a private benefit group. So practical issues for HOAs. Gated home associations that primarily benefit members and lack unrestricted public access face a significant hurdle in qualifying for C4 status. It's not impossible, but it's going to be difficult, right? And in essence, you got to be way more open than this one would be to have a shot. You got to advise HOAs that want to qualify under 501c4, their activities must benefit the community as a whole, not just the private property owners, to meet the primarily test. Basically, and that's kind of like the gate's one of your problems there. A gated community, fenced in and gated, that pretty much is meant to keep the non-members out, and so it's effective. Now, the tax court will not consider alleged arbitrary application of the law by the IRS to other similarly situated taxpayers. Each taxpayer is to establish his own, because they try to say, yeah, but we know a bunch of other HOAs that are just like us that the IRS has granted this to. And the court said, tough luck, they screwed up, right? You're in front of us now. We make the determination, and we're saying you don't qualify. Most residential HOAs rely on 528. Which is taxation only on not exempt income for their preferential status. This isn't going to be a huge negative for most HOAs, because they're not trying down the C4 path. But if you're trying to go C4, yeah, it's a little more of a problem. Next up, we're going to talk about a cancellation of indebtedness income, really fun. Let's visit section 108 again, and the variance doctrine. This is Romeo Solto Jr. and Phyllis Palega versus United States of America. This is from the Second Circuit Court of Appeals, case number 24-2700 CV, and this was decided also on October 6th. It was a popular day for deciding things. Now, this case involved the timing of cancellation of indebtedness income arising from discharge of mortgage debt. And this is somewhat important because timing can be key. Remember, in order to qualify under 108 for exclusion for being insolvent, you effectively have to show you were insolvent at the time of the discharge. Now, the debt discharge occurred, at least initially, the IRS looked at, so the taxpayer, when he executed a deed in lieu of foreclosure arrangements in January of 2015, he relinquished the property and secured a waiver of the deficiency judgment. That is how the taxpayers reported on their 2015 return. But later, after discovering some more facts, they sought a claim for refund, arguing the income should have been taxed in 2017. Now, the district court said, no, we're not going to buy that. We'll talk about why. And the Court of Appeals now has affirmed that district court ruling. 2015 is the year they're stuck with, right? That's going to be it. Now, income from cancellation indebtedness, a lot of people have trouble understanding this. But when you have cancellation indebtedness, generally that's taxable income. Section 61A11 specifically tells us that cancellation of debt income, basically if you have a debt canceled, that's income to you. Now, you can qualify under 108 potentially to exclude it under certain conditions, but that's a whole nother discussion. When do we determine when it's discharged? Because that, as I said, is important for 108, especially things like insolvency. The debt's deemed discharged at the moment it becomes clear the debt will never have to be paid. And that timing is determined by any identifiable event that fixes that loss with certainty. That's kind of like the bad debt write-off rule. This is the flip side of it, right? It's a cancellation of debt rule. The court found the execution of the deed in lieu transaction in January 2015 constituted that identifiable event. as the property was accepted in full satisfaction of the event, fixing the cancellation of income, cancellation of debt income recognition in 2015. Okay. Cancellation-of-Indebtedness, I should say. Now, on appeal, the taxpayers argued for the first time that the January 15 relocation agreement was unenforceable during 2015. Now, the court said this argument is barred by the doctrine of variance. The variance rules, when you're talking about a refund suit, requires a taxpayer must advance in the administrative proceeding any contention it wishes to pursue in court. Remember, if you're going to sue the IRS for a refund, in order to be allowed to do that, you have to first file your administrative claim asking for the money from the IRS. You have to give the reasons why you're asking for it. The IRS considers that and decides whether to pay it out or whether to disallow it, at which point then you can go to court. You have to go to court within 2 years after that point. You also go to court 6 months after you file the administrative claim if the IRS hasn't acted. So you have those issues. Now, the problem is the variance rules require that you got to advance every argument in that administrative proceeding. And the purpose is to prevent surprise. I mean, the whole purpose of having to file your claim with refund for the IRS first is to give the IRS notice of the claim and allow them to decide to have all of this handled without having to go to court. That's the point of that route. When you play hide the ball from the IRS, kind of ignore it and don't let them know all the reasons you're going to argue in court, yeah, they can't really make the decision. It's also not necessarily the smartest rule. It's just like paying your attorney to go that route. Now, the taxpayers conceded that they had not raised the validity or enforceability of the relocation agreement in their administrative refund. Now, the court rejected the argument that exception exists because the taxpayers discovered the contract was potentially unenforceable after filing the claim. The courts found the taxpayers knew or reasonably should have known the facts underpinning that enforceability theory, that the documents lacked the mortgagee's signature. They knew it back in January 2015. And yet they believed, and the lender at the time believed, that they were basically tying everything down. So, the vital caution here is if you are going to do a claim for refund, make sure you've investigated every possible option for claiming it. And especially if your client, it's big enough your client's going to consider going to court. You want to make sure with legal counsel that you've gone through and found every possible argument they might want to advance in court. Because as noted, if you don't do it, well, things don't go so well. Hey, 5 days and then we got to redo things. The IRS contingency plan was extended. So we're going to take a look at what's going to happen to tax practice and filing season preparedness. This is the updated IRS fiscal year 2026 lapse and appropriation contingency plan that took effect on October the 8th. Remember, the first plan we talked about last week only said it would work, only said, it was committed for 5 days. So what did the IRS do after the 5th day? So this covers a lapse that starts on October 8th and continues potentially all the way through April 30th, 26. That is theoretically the next time they would come up with a new plan. Hopefully they don't need to go that far. Now, this plan still uses exceptions in the Anti-Deficiency Act, including activities supported by non-expiring funds and those necessary to protect government property. 39,870 employees, or 53.6% of the total workforce that was there. Remember, we've had to cut back about 20% before we got started with this. Are essentially designated as exempt and will be retained. Not all will be paid. Retained related activities fall into Category A1 from non-expiring funds, Category A3 implied duties, and Category B to safeguard human life and government property. And as far as I understand, only Category A1 is going to get paid. Okay. Number one thing they wanted to do was get ready for the tax filing season for 26. So that means completion and testing of filing year programs and design and printing of necessary forms of publications will continue. Also, they're going to process payments, including payment protection, and necessary mail opportunities continue because the tax revenues are considered government property that must be safeguarded. So that's when Category B. And submission processing field directors will process tax returns specifically containing remittances. Okay. Now, implementation work related to legislative changes such as, the OB3, Public Law 11921, are going to be sustained by the accepted personnel. The idea is to get that going, get guidance out on this. This includes developing the guidance, updating the tax forms, and conducting review actions for energy credits via the ECO portal. The activities necessary for protection of statute expiration, bankruptcy liens, and seizures will continue under Category B. In essence, the IRS is going to make sure they don't lose legal protection. And Chief Counsel staff are expected to manage pending litigation that requires time-sensitive filing of motions, briefs, and pleadings, assuming courts remain open, because remember, the courts are a separate issue. And we'll have to see how that goes. There are a number of non-accepted services, though, that are being terminated. So some of those are going to cease, include responding to taxpayers' questions via call sites outside of filing season, processing non-disaster relief transcripts. You want a manual process of transcript? Not going to happen, right? That's how it's going to go. Or providing legal counsel regarding non-accepted activities. The IRS.gov website will maintain operation with staff retained to publish web content for information distribution, and the Income Verification Express Service, IVES, and RAIVS photocopy programs will continue, supported by non-expiring funds. Yeah, I don't want to really screw up the mortgage market. We'll phrase it that way. How about CPA EA support functions? The Tax Return Preparer Office retains a very limited staff, exactly 8 people, right, to support contract systems that serve over 800,000 tax professionals. The Taxpayer Advocate Service is down to 93 positions. My understanding is the taxpayer advocates in the offices primarily focus on monitoring and ensuring the process of cases where a statute or statute extension is expiring. Taxpayer Advocate Service staff are also retained to screen mail for incoming requests for taxpayer assistance orders, but again, classify them out. And Accounts Management retained personnel to provide additional support for centralized authorization file and employee identification number programs. But anyway, it's going to be a little bit different IRS you're going to deal with for a while, at least until this gets solved. And again, remember last time they really shut down, it went for over a month. So we still may have quite a bit of time left in this shutdown. Next up, we got our 2026 inflation adjustments. So Revenue Procedure 2025-32 came out on October 9th of 25. Now, the Revenue Procedure sets forth inflation-adjusted amounts that pertinent to the 2026 tax year. It does incorporate its changes made by Public Law 11921 OBRA, which amended prior guidance. And remember, that made the existing 7 individual income tax rates permanent. The other thing is, because it resets some numbers and then have you inflation adjust after that, things like the amount that you can transfer on death, what will go to $15 million, the unified credit for someone dying next year, that's not in here this year because that's not an inflation adjusted number this year. That's just what the statute set it at. Let's talk about some things that were inflation adjusted. Standard deductions are going to be up to $32,200 for married, filing joint, and surviving spouses. For single individuals, $16,001, and for unmarried head of household, $24,150. The maximum zero capital gains rate for married, filing joint will go to $98,900, and the maximum 15% capital gains rate will go all the way up to $613,007. And the highest marginal rate for married, filing joint will start at $768,700. And again, adjusted, it's in the printed document. If you go download that from the website, we'll have all of the rate tables and stuff. These are just some of the keys. Again, we're doing mainly joint returns for these numbers, but the AMT exemption for a joint return will become $140,200. The AMT threshold phase out will begin at $1 million. The Section 179 maximum expense begins at $2,560,000. That's maximum expense, and the phase out threshold will begin at $4,090,000 of acquired property. The QBI deduction threshold for a married filing joint taxpayer will be at $403,500, and it will complete the phase out at $553,500. Remember, we're getting a longer stretch period. So keep that in mind. That actually takes effect this year, that is next year it takes effect. I got to get that right. The child tax credit maximum amount will be $2,200. The child tax credit refundable portion will have the amount used for termination will be $1,700. The earned income credit disallowance threshold, aggregate investment income exceeding $12,200, will kick you out. The adoption credit exclusion, maximum amount of $17,670. The adoption credit phase out begins at modified adjusted gross income exceeding $265,080. Now, compliance and estate and gift updates. As I said, the $15 million is not in here because it's just, that's our new starting point. That's the starting point in 26. It'll be inflation adjusted in 27. The annual gift exclusion, though, is still subject to an adjustment. It'll be $19,000 next year. Some penalties here. Failure to file a tax return minimum penalty for 2027 will be the lesser of $535 or 100% of the tax shown. Information return failure penalty will be for under 6721 and 6722 for 2027 filing years. Those filed in 27 for 26 will be the return statement penalty of $340 apiece. Tax return due diligence penalty under 6695 and in the 27 filing year will rise $665 per failure. And the attorney fee awards limitation under 7430 for calendar year 26 will be $260 per hour. Again, inside of the revenue procedure, there is all of this information, so you can go look at it there. Next up, let's talk about another tax court case on October 9th, Tax Court Decision 2025-105, which is the case of Armand Gabrian and a whole bunch of others versus Commissioner of Internal Revenue. This has to deal with accounting method failures. This guy was doing interesting accounting, had an accountant doing some really interesting accounting, and the IRS use of income reconstruction. In this case, a corporate taxpayer, Lakeview Hospice Care, used the accrual method, but had wholly inadequate record keeping. It claimed to be accrual, but it had lots of issues, right? It includes unusual journal entry reversals and failure to properly debit accounts receivable. And I mean, the records were just so bad, nobody could figure out how to get them to anywhere. So the IRS properly used a bank deposit analysis to reconstruct corporate and individual income. That analysis sought to impose additional corporate income of $72,829 for 2015, $110,016 for 2016, as well as additional income for the individual taxpayer. When the records are inadequate, 446B allows the commissioner to determine income using a reasonable method. And the crucial step for accrual taxpayers analyzed using a cash basis method, bank deposits, is the accrual conversion feature. That requires calculating differences in accounts payable and accounts receivable to avoid overstating or understating income, right? And the court found the revenue agent did that. We all know, right? Everybody except, I found years ago that people that worked only in really large firms seem to not understand this. But basically, you can take cash financials and you can adjust them to accrual by looking at beginning and ending balance sheet. Right? It's basically how you do it. Yes, it's not absolutely perfect, but as I pointed out a couple of times to people that have complained that to me, it's like, look, guys, no set of books is absolutely perfect, right? Everyone is a range. So, it's going to be as good, pretty much as good as getting it done all the way officially accrual. In fact, especially given the mess that this accountant made of the books, probably better than happened in this case, right? Now, on income and deduction, the court agreed with the taxpayer specifically identified deposits, transfers between accounts and non-hospice sources were non-taxable deposits and directed there be adjustments computed under Rule 155 at the end of the case. The court sustained this allowance over $200,000 miscellaneous accruals and advertising expenses due to an extreme lack of substantiation, lack of invoices or receipts, and the $171,032 net operating loss deduction was disallowed because the taxpayers failed to keep books and records necessary to substantiate the carryforwards. Prior returns alone are insufficient. This is something you have to hammer home on NOLs. You got to be able to back up the NOL number. You can't just say, well, that's what I carried from last year. Great. Was last year right? But that's closed, right? No, that was like 5 years ago where this loss came from. No, it's not closed for that because it impacts the tax for the current year. So yes, they can force you to go back 20 years if that has an impact on the carryover and bring everything forward. So understand that with NOLs, it's not good enough just to keep copies of the returns. You got to have records to back that up. Now, on penalty relief, the taxpayer did a bit better here, right? The IRS was looking for accuracy-related penalties under 6662. But the corporation successfully asserted the reasonable cause and good faith defense. And the court went this way because of evidence that the Garibayans relied on two accounting professionals, and one of whom was responsible for what the court referred to as bizarre ledger entries, right? So despite the court criticizing sufficient bookkeeping, that's not good enough to set your income. The court found reliance and effort to manage the complexity of the hospice pass-through billing met the burden of showing good faith. Lakeview was not liable for these penalties. Still had tax, wasn't liable for the penalties. Finally, we're going to take a look here at a case involving an ERTC consultant, and not one of whether or not the person, whether or not, the IRS is not disallowing something. It's not that the that the IRS is examining. It's that it's a little different how we get here. But the problem we're going to find here is a requirement when you're going to sue somebody for damages in federal court. You have to show a concrete injury. And the ERT consultant, we'll talk a little bit about it, and we'll talk about where this goes. This was a motion to dismiss the case. And what the attorney for the defense was arguing and persuaded the district court in Utah to accept was that it didn't matter if everything they alleged about how awful and horrible the advice they received from these consultants were. Let's just accept all of that as true. They're not going to concede that if we go to trial, but let's just concede it. If they can prove all of that, which again, we're not conceding they can, it wouldn't matter because these guys ended up with $70,000 more in their pocket than they started with. There's no damage to remedy here. This is the case of Greenway Equipment Sales, Inc. versus ERC Specialist, LLC. Again, District Court from Utah, U.S. District Court in Utah, case number 2:24-CV773. And this case came down on October the 8th of 2025. Now, this is litigation. They are suing the consultant because they felt that the consultant essentially gave them bum advice. Basically was just, effectively they're arguing, well, they were operating just as a pure mill, right? They weren't really providing the services they claimed. They weren't at least living up to the quality they should have. Okay. So the taxpayer, Greenway, sued its consultants, which is ERCS, after receiving $729,567 in credits based on what they allege was faulty qualification advice. Now, as we all know, during the period where the IRS is throwing money out left and right, there clearly are some claims that were sustained that, weren't really good. In fact, I remember just before the program we're going to talk about here, I remember sitting through a House Ways and Means Committee, basically the Oversight Committee, subcommittee, hearing on how bad the ERC was. And, you don't think you see people on both sides of the aisle agreeing all the time in Congress. But in this case, everybody was piling on ERC consultants, not these consultants, but, on those who were out there doing consulting work in this. There were a whole bunch of abusive ones. In fact, one congresswoman pointed out that she had gotten 2 calls on her way to the Capitol from somebody trying to sell her on having her business that had been out of business for 10 years apply for ERC credits. And that they qualify. Doesn't matter, you weren't in business. It's like, so it was the wrong person to talk to, but that's another mess. Greenway subsequently determined it did not qualify. So it had received $729,000 in credits. It got cold feet, and it brought in another consultant. And that consultant reviewed in depth their revenues, the orders that applied to them, the effect of those orders, and they told them that they believed they really didn't qualify, and certainly not for all the quarters that they had applied for it. And so because of that, they participate in the IRS's Voluntary Disclosure Program, the VDP. Now, you remember the VDP, the first version. This is like the first version of it. And that program allowed you to give back your money. But you didn't give back at all. You gave back 80% of what you got. So they essentially got to keep over $140,000. They would not be charged interest nor penalties on the money they paid back in. And they get to keep the interest that had been paid on the claim. So it was a pretty good deal. The reason why they only paid back 80% was because a lot of the consultants were doing contingent fee arrangements. And those fees often got up into the 20% range. So essentially, if somebody realized I got hoodwinked, let's say that's what they believe, and they wanted to give back the $800,000 that they'd received, well, they couldn't because $160,000 of that was in the hands of the consultants who weren't going to give it back, right? They said, look, you got paid it. Nobody's coming after you for the money right now. We're not giving you that money back. So in order to encourage voluntary, return of funds, they decided to make it possible by just requiring to return the funds they actually received, got the benefit of. But it wasn't really limited that way. Just simply use a flat 20%. You didn't have to limit it to what you had paid. Now, in this case, Greenway, had paid an upfront fee of 10% to the consultants. That's also been unusual as upfront. Now, the upfront fee, as we'll discover, said that if the IRS denied the claim, never paid it out, that they would refund the 10%. But once the IRS paid the claim, that was it. There were no refunds from that point, even if the IRS came back later and took it back. Now, as you note, the math is pretty straightforward here. If they were charged $73,000, right, just about $73,000 to file the claim, and they effectively netted, therefore, $73,000 when they paid back 80%, because, 73, so basically they and the consultants split the 20 effectively. They said, look, the taxpayer lacks Article 3 standing. They cannot show an injury that the court can compensate. They weren't injured. They're ahead. They're better off because they went this route. Okay? So you can't really sue. And that's true even if it's wildly, let's say absolutely, they could prove without a question, which again, we're not saying they can, but we're going to assume that for purposes of dismissing the complaint. Let's assume they can prove everything they're alleging about just how bad and low quality, this qualification advice was. It was faulty and totally wrong. If you're not damaged, you don't really have any way to go to court to sue. Okay. So in order to establish standing, the plaintiff's got to prove the injury is concrete, particularized, and actual or imminent. Basically, you got to be able to show three things. That you incurred damages, somehow you were damaged, and money is a way a lot of times damages are going to be sold. There has to be something to be fixed. You have to show that the party you're suing caused you to suffer those damages, and you've got to show that there would be a way to remedy the situation to make you whole that the court could do. Now, in this case, Greenway repaid 80% of the credit, retained $145,931, and paid a $72,965.70 fee to ERCS, resulting in retaining positive financial outcome of $72,965. There's no damages, they're negative damages, right? They're better off. The court concluded that because the employer was net positive throughout the process, the retention of the fee by the consultant was not a financial injury. If anything, it was U.S. government being injured, right? In essence, by having this fee. The contract actually did anticipate subsequent disqualification. And they signed a contract that said, while they had to refund the money if you weren't paid, if the IRS disallowed your claim, If the IRS later came back and took back the money, they didn't have to pay it back. They signed an agreement that said that. Okay, maybe they didn't read the agreement. Maybe they weren't aware. But, doing something dumb, we're talking about a $800,000 claim, or 700, should say, talking about basically a $730,000 claim, refund claim. You might think it makes sense to hire legal counsel and have them review this. Review the contract before you sign it with this consultant to do that. Okay. Now, what they said was, okay, they agreed that they basically got this, what they paid back was only 80%, and the consultant only took 10%. So they agreed on paper there, they were ahead of the game, right? They just paid it back, they're ahead of the game. But they argued for other types of harms, and the court rejected them. They rejected them because the court found that these were speculative. Now, the employer claimed injury based on the fear of future IRS reassessment or penalties. In essence, they were fearful, and they had to go through all this fear and suffering because, they had been given this bum advice, and they had to go out and hire this other group to study it and pay it back. And, they should never have been subject to that stress. Had they not done any of this, they wouldn't have been stressed. They'd have $70,000, but they wouldn't have been stressed. That's there. The court found this fear-based harm was speculative because they admitted to participating in the voluntary disclosure program, mitigated and avoided all of these hypothetical potential penalties in the future. They were out of it. The only thing you were open for there was potential criminal charges, in which case you were supposed to be booted from the program. So essentially, once they were accepted and paid in, all of these speculative harms were gone. The IRS was never going to examine them and take back the money. The IRS was never going to penalize them or charge them the interest. The court said harms merely potential or speculative is insufficient to establish standing. And again, it's Article 3 of the Constitution trying to go under. And they said, but what about hiring the consulting fees and the legal counsel to pursue the case? We brought all these people in to, advise us. And the court said, costs incurred to bring the lawsuit, the consulting fees and legal counsel cannot themselves be used to manufacture standing. Maybe a weird thing if, we didn't lose money, but because we hired this attorney, we're going to pay, now suddenly we're out the money. It's like, you shouldn't have hired the attorney. That sort of thing. You probably shouldn't have pursued collection. And as we said, you could have just paid back the money. The outside consultant, I think the argument there too is very simple. You should have hired this other consultant to advise you to start with, but you would have paid them for that too. So it's not as if you're really damaged by any of that. So what's the implication for disputes in this case? And when you have consulting or tax advice, the tax advice disputes, obviously you've got to be able to show a true monetary loss or imminent non-speculative harm that the taxpayer faced. In this case, you use the voluntary disclosure program essentially precludes subsequent litigation against a consultant if the taxpayer retains a net financial benefit after accounting for the fees and the repayments that are involved. So bottom line, if the consultants in this case had charged a 30% fee, then they would have probably had a case. That's damages, right? They had to pay back 80%, but the consultants got a fee of 30. There's damages there, right? Now we could go and if they really gave bum advice, then yes, there'd be damages in that case. Again, but you'd have to prove they gave bum advice. Remember, the court here is merely assuming that they can prove the advice was horrendous, awful, way below standards, and just, didn't work at all. And if you actually read, the case, you read the complaint, you're going to find that if what they alleged could be proven, it sounds bad. I mean, as they noted, they never did any work on gross receipts, which seems odd because that's the easiest way to get the ERC. And they never, and they knew that this company had never faced a shutdown, had never seen receipts go down, and yet they decided they were eligible. However, as the court pointed out, you went ahead and signed the contracts and did everything before you ever knew, basically before you ever answered any of those questions. So, they got the questionnaire. This is one of those questionnaire setups. So, yeah, does it sound like they weren't the most thorough? If what the plaintiff is saying was true, yeah, it sounds like, certainly whoever the person was involved with this particular claim, because this is a large group, may not have been right on top of it. But again, we never got to decide if that was or wasn't true, or if they were just slandering the guy, because it didn't matter. Right? Even if they found that he was horrid, he should be in jail, he was a tax fraud, I don't care how bad it was. No damages, no case. So, you got to counsel your clients. If they in fact paid a fee less than the 20%, it's not terribly likely you can go back and sue those guys, even if you're mad at them, because, they gave you so much stress. I go talk to counsel, but certainly I would say we all know the problem is going to be showing damages here. Can you show actual damages, right? Not just speculative, because as I said, the voluntary disclosure program essentially got rid of all the issues. And that was, a very different structure than if you had not had that option, you hadn't gone into that voluntarily. Because ultimately, I'm sure the consultants would also noted that, and the court pointed out, they had never been threatened by the service, because if they had been, they couldn't be in this program. The service hadn't notified them they were being examined, hadn't indicated a problem yet. Now, I understand you can't be in VDP under that program if they had, but, that was pure and simple. It's like, so, the supposed fear was, was one that may have been correct. Like I said, if everything worked exactly as alleged, yeah, I would say they'd be concerned. But as I told people in the ERC regularly, I said, look, yeah, in that case, I would consult people usually who were talking to who were talking to clients that had gone to a mill, and what should they do? And it's like, well, here's what you tell them. Like I said, bottom line, if you've looked at it, you don't see they qualify, you say, I don't think you qualify. I would recommend that you amend. You can do voluntary disclosure, get out of the program. That's an option. It would solve a problem, because then the service can't show up. But I would also say you better be clear with them, though, that given the sheer number of claims out there, and given the sheer number of these, there is a very good chance, that your claim would never be looked at, no matter how bad it is, if they paid it. Now, I realize during part of this, Congress was threatening, to extend the statute and do other things that would have put it at more risk. So I understand the back and forth there, but that never passed. Reality is, a lot of statutes have now closed. And, people that the IRS never opened up an exam on, and they got the refund over 3 years ago, for the most part, except those at the very end of the program, their statute's closed. Right? They're pretty much safe unless the service could show fraud. That's the reality of it. This has been the Current Federal Tax Developments for October 13th, going into the final deadline this week. As always, my email address, edzollers@currentfortaxdevelopments.com. You have a couple quick questions. I also participate on the Connect sites for Arizona, New Jersey, Minnesota, Idaho, Illinois, Washington. I keep an eye on those if I can. So if you have questions, you can post them there for those state societies. Otherwise, we'll look forward. Next time I see you, we'll be past the deadline. Could be fun, and we'll see how everything else goes. But otherwise, I want to thank you for being here this week, and we'll see you later on Current Federal Tax Developments.